Run us through what the core and satellite approach is in a portfolio for those that are not familiar with it, how it works and what the advantages are.
So because we just spoke about,
Yeah.
the risk appetite of an individual, I feel, Abha, here what's important is that we define our overall portfolio into two baskets, which is one is your core.
Yeah.
Core is that basket of your portfolio wherein you're having products which match your own risk appetite. So if I'm a conservative investor, my core would be probably products like a public provident fund, employee provident fund, more of fixed income products. And then my satellite would be something where I can take slightly higher risk. So for a conservative investor, their core 60 to 70 or 80% would be these, traditional fixed income sort of products, and that probably 15-20% is something where they're looking at higher returns and they can step outside the comfort zone and invest, which would be part equity or a combination of equity and debt. While it would be the other way for an investor who's aggressive, and for them, the core would be, mostly equities. And within equities, the core ideally should be simpler products. Within equities, it can be formed of index funds, exposure to large cap index funds, mid caps. I think we have so many good passive strategies now coming in India, and even exposure to outside India. Okay. And for them, their satellite would be simpler products, probably in the fixed income space.
Okay. When investing, what is the kind of investment horizon one should look at, and also corpus? Would you suggest putting aside 20% of your income? Would you say it's okay to invest even the most nominal sum, let's say through an SIP route? And let's address perhaps a retail investor first, and we can always come to other segments after that. But for a regular investor, and if you could define perhaps via an income bracket, what would be a reasonable corpus to suggest investing in with, let's say, a medium to long-term horizon?
So I feel, Abha, if we're just looking at international investing currently, then this segment can be about anywhere ranging between 5 to 20 to 25% also, depending on the goals of the investor. Okay. Because if, let's say, somebody has a kid who's just about 1 year old and they do plan to send their child abroad for further studies, so 17 years later, they would be paying the fee in dollars. So I think for them, maybe the allocation outside India can be higher, maybe even 25 to 30%. Okay. But of course, the element and the underlying nature of stock markets remains the same, whether we are investing in Indian equity markets or outside India. So that must be remembered. And, that is something which investors have to be very cautious about. That yes, it's not that if you're investing outside India, then there is no risk or there won't be volatility. That will be there. And I think this year beginning, we've seen already a lot of volatility and drawdowns a bit even in the US markets. And otherwise speaking broadly, general investments, then I would say that a small corpus, a small sum of, let's say, 10,000 SIP over a 15-year period through mutual funds can actually create a basket for them for about 50 lakhs over a 15-year period, considering a 12% return. And I think 10,000 is a reasonable amount, which probably even young kids of today who just started working, and a lot of people can afford to invest. And this little amount, if they do this increment of, let's say, this year my monthly SIP is 10,000, and the next year onwards it's 11,000, and hence it's 12,000. That can actually create a corpus of about 96 lakhs in the same time period. So investment up to about 25 to 30% of their salary, I think, is a great thing. Loans shouldn't be too much, I feel. That has to be contained as well. Even if you're not investing, it shouldn't be that let me invest and take a home loan to buy a house to save taxes. That approach would be wrong.
All right, Prableen. Thank you so much for joining us.